The consensus out there is that the Fed is going to, people are more kind of timing the pivot and less about, there's still this conception with a lot of models that the 10-year Treasury is the risk-free market, right? And I want to kind of grab people and be like, I'm not sure about that. I think all investing involves risk. The market is not expecting the Fed to lose control over inflation expectations. And I think that presents an opportunity for investors to say, look, the market's already so rosy and optimistic that the Fed's actions with hiking policy rates are going to kill future inflation expectations. I actually think it's a great time to say, look, it's priced cheaply. We don't know whether the Fed's efforts are going to be successful or not. We don't know if it's going to be, these rate hikes are going to cause a recession. We don't know whether it's going to be a more of a risk-on environment, which like we've saw in January in the equity and the credit markets. We just don't know. And so I think part of a diversified portfolio includes having some, inflation-linked assets. And, one of the things that I'm really kind of feel like I want to stand on my soapbox and tell the real vision world that you gotta, a lot of people look at what happened in the 70s, right? That's kind of the playbook, right? You say what existed, like what worked in the 70s, what helped either with stagflation or inflation. And a lot of people look at, whether it's commodities, whatever type of commodities, or it's equities, or it's real estate, or, whatever people are looking at. I like to grab people and say, look, the U.S. Treasury Department did not start the inflation protected bond markets until the late 90s. So there is no inflation protected bond market to look at in the 70s. Even the swaps market didn't start until the 80s, the later 80s. And so it's really important to look at the broader picture and say, like, when you're thinking about inflation protection, not to have all your chips in, one basket that was what was around in the 70s.
Okay, that's hugely important. That's hugely important. So as we're thinking about that, why do you think these newer instruments are going to be a better option than maybe the commodity or they're going to replay of the 70s? Why would they perform better? Why should we take advantage of these new instruments?
Well, I don't know if they're going to perform better. Like, I think better is a relative thing. I just don't think you only want to have what existed in the 70s because, very simply, if you're looking for inflation protection, why not use the interest rate derivatives markets? Those didn't exist back then. The inflation protected treasury market didn't exist before 97 was when it was created. So I think it's kind of just, look, close your eyes for a second. And definitely we're having, an energy crisis right now. The invasion of the Ukraine has contributed to that. Not to get, into political hot buttons, but like the ESG trend has contributed to that. So there's a lot of like infrastructure shortages, but a lot of people look at, say, oil and say, oil was a great inflation hedge, but that was a very specific thing with the embargo with oil back then. And I'm not saying it won't work in the future, but, close your eyes 20 years from now, I personally see a lot of other sources of energy, a lot of other, technology that could potentially make some of those, let's just call them 1970s inflation protection, maybe not work going forward. So I think it's just important to have diversification in all aspects of your portfolio. And I think the challenge is a lot of investors just don't have a lot of diversification for inflation. Inflation protected bonds did not work last year. Let's just highlight that as well. Like, did not work. Inflation expectations fell dramatically in 2022. You can even look at, maybe as a slide for this webinar, we can show the break-even level. And basically the Fed started hiking rates. Think about it. It's February 14th. Happy Valentine's Day, by the way.
Thank you.
And less than a year ago, the Fed had not even started hiking rates yet. The market had expected the Fed to hike, but their first hike was in March, and they've hiked 450 basis points of actual hikes so far, but that cooled inflation expectations dramatically. So real yields rallied hugely. So real yields moved up, which is bad for inflation protected bonds. Break-even curves fell, especially front-dated break-even curves. Like the 1 year, 2 year was, above 6 before the Fed started hiking rates, and fell dramatically to, call it 2.5 by the end of the year, and where we are now. So I think that's important to emphasize, is that the Fed really has convinced the market that hiking policy rates is going to ease future inflation expectations.
Is that assumption wrong, do you think, or overly complacent?
I don't know it's wrong. I'm not sure. I can see a lot of reasons, like, CPI, let's just maybe just take a step back. CPI is an index, right? It's a consumer price index. The weightings just changed this morning. It's an index that's calculated by the BLS, the Bureau of Labor Statistics, and about a third of the index is what they call shelter, which is owner-occupied rent. And so I personally, compare it to, say, equities. You would never say I'm buying the NASDAQ or the Russell or the Dow Jones or the S&P index, and I have the U.S. equity market, right? Inflation is a bigger, harder thing to measure. Inflation can vary person to person based on, do you have a college student? What are your medical expenses? Where do you live? What part of the country? What's happening to home prices? Like, there are a lot of variables to measure inflation. And even the Fed themselves don't use, the CPI index. They focus more on the PCE, but there are a lot of different indices out there. And I think that's why it's important to try to have other measures of inflation outside of just the CPI.
Yeah. It's incredible that those future expectations are so well behaved, because when we started out and the Fed was getting ready to hike, they had so little credibility because of the whole transitory, because they waited. And that's all people were talking about. And now we've seemed to have gone, 180 degrees in the other direction. And people are absolutely convinced not only that they're going to tame inflation, but they're going to achieve a soft landing, which has rarely ever happened. It seems that it's such a sort of rosy outlook. Even just today, we have the CEO of Goldman Sachs saying, the odds are increasing that we have a soft landing. It seems almost too good to be true.
Yeah, well, I think it's always important to be nimble, to not be stuck on different philosophies, and to build a portfolio for different outcomes. You don't want to have, if you think, like, say you do think things are going to be rosy, or you think it's going to be the end of the world, you never want to have all your portfolio in one theme, one way to win. And so I think it's just important that, even look at the Fed rate hikes. There are not many people in the market that, if we, rewind 1 year, if it was February 14th, 2022, there are not many people who would probably have come on Real Vision and said, I think the Fed's going to hike 450 basis points in the next 12 months. Like that was
without breaking anything very obvious.
Yeah, without breaking anything. That probably isn't something a lot of people said. So I think it's important when you're constructing portfolios to not try to predict, what policymakers are going to do, right? It's very hard to get that right. And then even if you had a crystal ball and you knew what a policymaker is going to do, it's really hard to then figure out what markets are going to do, right? Because those are not always, if you said, to someone, hey, the CPI is going to be above, 6 for the next, X period of time, a lot of people wouldn't have said, well, inflation expectations in the future would be, still around 2.5, or around the 2% target. So it's just, I think it just goes back to diversifying. And I think the one positive that I see from 2022 is a lot of investors are really questioning that traditional 60/40 portfolio, having, stocks and bonds, and is it going to work? And can you just stick with these benchmarks? Or is it time to really be thinking more about what's under the hood and what makes up these portfolios, and try to look for things that can help diversify, right? Because the whole point of, that search for non-correlated assets is to just have not everything lose money together, right? And
which is what happened to so many last year.
Yeah, 22 was, outside of like a few things like the dollar and energy. Like if you take energy out of the the U.S. equity markets, that was like really the only thing that really worked. And so I think it's tough you want to look at what's going to be next, what's going to be in the future. And it's all about what's priced in. And, that's kind of why I wanted to come on your show, because you have a great audience, a lot of sophisticated financial professionals, and really emphasize that you have to look at, it's just like volatility, right? You have realized volatility, and then you have implied, which is what's in the future. The inflation markets have the same principle. You have realized, which is, the CPI or the PCE or whatever measure you want to use today. And then there's the implied market, which is what's priced in for the future. And if you look at the 5-year, the inflation break-evens, the yield curve is, the swaps curve is the most inverted. It's been, in the history of the swaps market data going back to the 80s. So the swap market has more data than like the CDX markets, the credit derivative indices, really don't have data before, kind of maybe you can go back to 2004. So it was really the financial crisis that when the data started to be, a lot of people started to trade index and credit. The rates market, the rate derivatives markets, the swaption data, the swaps market doesn't, go back that far. But if you look at the swaps curve, especially globally, the swaps market is priced like it's the end of the world. It's priced for Armageddon. It's a lot of people are like, well, is the swap market, the yield curve, a predictor of recession, or is it a cause of a recession because lenders stop lending? But it's massively inverted, and I think that's really important for investors to pay attention to and to be aware of what's going on.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.